learners. Welcome to today's class. Today, based on our last class, we looked at public finance, and taxation is one of the topics of public finance. Remember, I told you when I was introducing taxation in our last class as well, that is one of the major sources of revenue for the government. So every country of the world collect tax, be it developed nation or developing nation. Now let's give an example of our country, Nigeria. People pay tax. Now the money gotten from tax is used to provide social amenities to the population of the country. The money used from tax is used to pay salaries of teachers. So we can't overemphasize the importance of collection of tax. Is a major source of revenue for the government. So the question is this: what is tax? Now, as you can see on your screen, tax is a compulsory levy imposed by government on the income of individuals and firm and goods and services. So tax is a compulsory levy that every citizen of a country must pay. So far you are working, meaning you're an adult above 18 and above, and you are working, then you need to pay tax. It's compulsory. It's your civic duty. And failure to pay tax is tagged as a criminal offense, which might lead you to jail. So in Nigeria, we have a lot of firms, companies, individuals that have tried to evade tax. They don't want to pay tax. And some of them have find themselves in a lot of trouble. So tax is a compulsory levy that is paid by everybody. Now let's look at the elements of tax. The element of tax. Now, tax has two. The first is the tax base. The tax base. That refers to the object or the material which you are taxing. For example, for me, as a facilitator, if I'm being paid income every month, now that income that I've been paid every month, the government will come in and collect tax from it. So the tax collected from that money, the money I collect, is what we call the tax base. That's the income that I am collecting. So my personal income is my tax base, in which government will remove tax. We have tax on importation and export. We have company profits. We have tax on properties. We have tax on goods for sale. So all these are tax base where government collect money from. So take note of what tax base is. Tax base is the item on or object which you pay tax on. The second we have is what we call tax rates. So tax rate is just the percentage, just a percentage or portion of tax base or object which is paid as tax. So a good example is what you can see, that the rate of tax can be expressed as a percentage, 5% of income. So that income is my tax base, while the 5% is the tax rate. So if I will give another example, if my income is 10,000 naira, 10,000 naira. That's my income. So that's a tax base. Now, and I'm asked to pay 10% of that as my tax. So the tax rate is 10%, meaning I'll be paying at the end of the month 10% of 10,000, which is 1,000 naira. We have other tax rate as what we call the ad valorem tax. For example, is expressed in form of percentage. We have the poll tax, which is a flat rate. That is not expressed in percentage, but expressed in the country's currency. So, for example, they can ask all the adults in the country to pay 500 naira as tax. So, function of tax. Now, there are certain position of tax by the government of a country, and the first there is it is used to raise revenue for government expenditure. The government have a lot of responsibilities, a lot of expenditures, which I've discussed with you in the last class. So if I quickly rush through some of the government expenditures, number one is that government have to pay the salaries of civil servants and public servants. Two, government have to provide security for the people in the country, both internal security and external security. Government have to provide infrastructures for industries to be able to thrive. Now, all these need money. So government have to raise fund for this through tax. So it is used to raise revenue for government to be able to meet all their various obligations and their various expenditures. Now, tax is also an instrument to help to redistribute income. Now, what tax does is that tax collect money from both the poor and the rich, but the rich pay more than the poor. So indirectly, income is being redistributed. The rich pay more, the poor pay less. Now, this money is brought together to provide social amenities that both the rich and the poor will enjoy. So we can say that's a form of redistribution of income. Taxation can be used to reduce the production and consumption of commodities which are considered harmful or luxurious. For example, you'll notice that on the pack of the cigarette, it is written there, Federal Ministry of Nigeria warns that tobacco smokers are liable to die young. And even with that, you see people smoking. Now, what government do to discourage smoking is to tax those companies that are producing this product, meaning the British Tobacco Company now in Nigeria. They tax them more. And because of the nature of the commodity in question, is inelastic, is an inelastic product. So what the consumer or what the producer would do is just transfer the burden of that tax on the consumer in form of high price. So you will now notice a stick of cigarettes being sold from, let me say, 10 naira to 50 naira. So this is done to discourage the consumption of harmful products. Sometimes government might want to discourage the use of luxurious product by the rich. And that's why government sometimes tax them more. But we know they are rich, so it's one avenue for government to raise fund. So the rich will always pay because they are accustomed to luxurious goods. 4, tax can be used as an anti-inflationary device. So if a country, we know what inflation is. Inflation means a general rise which is persistent in the price of goods and services. So if a country is experiencing inflation, then government can use tax to try to curb or mop out money from circulation. So to a layman, inflation means too much money in circulation. So when there's too much money in circulation, it means there's too much money in the hands of the individuals. So what government would do is to try to mop out money in the hands of those individuals by increasing the tax they pay, especially personal income tax. So if I'll go back to the example I gave initially, that I'm collecting 10,000 naira and government asks me to pay 10% of that, which is 1,000 naira. So if the country is experiencing inflation, so remember that I have 9,000 to spend. So if the country is experiencing inflation, can I say, okay, instead of me to pay 10% as tax, it will be increased to like 30% as tax. So meaning government will be collecting from my hand 3,000 naira. I will be left with 7,000 naira to spend. So that has reduced the money in circulation, which will also go a long way to curb inflation. So a lot of countries do this, especially when they are facing the problem of inflation. The fifth one is this: tax is used to protect and encourage and key industry. Now, when we talk about protecting and encouraging infant industries, these are industries that are still young. These are industries that can compete favorably with international industries. So, some of them local industries. They are also into production of goods and services, and they also want to be big enough to export these items to other nations of the world. But they are operating in a competitive market where we have multinationals also leaving their own country and coming to the local market of that country to also market. So what government will do is to try to protect this infant industry by encouraging them to produce more, and then sometimes government can give them what we call tax holiday or reduce the tax they pay, and sometimes government can even impose high tax on the multinationals in order just to protect the infant industry. Remember this: if government impose high tax on industries, the industry can transfer the burden of such tax to the final consumer, depending on the nature of the commodity in question. If it's elastic or inelastic, or unitary, or perfectly elastic, or perfectly inelastic, depending on the nature of the commodity. So take note, tax can be used to encourage infant industries to come on board. Government can do that by reducing the tax they pay or giving them tax holiday. It is used to correct an adverse balance of payment. So when we say adverse balance of payment, we're talking about deficit balance of payment, meaning this is when your payment on importation is higher than exportation. So if this happens, government can try to discourage importation of some items by increasing the tax, which we call tariff, on such items, and encourage more exportation by reducing the tax paid on such items. I will repeat that again. It is used to correct deficit balance of payment. When we say deficit balance of payment, we are talking about importation is greater than exportation. Remember that importation is a linkage, while exportation is an injection, meaning when you import into your country, money is leaving your country, which is not good enough. And when you export, money is coming into your country. So it is believed that a country should export more and import less. So if that happens, it is called surplus balance of payment. But the best is what we call balanced balance of payment, where your importation is equal to your exportation. But that might be difficult to achieve, especially in a country like Nigeria. So how do you correct deficit balance of payment? By government discouraging importation of some items, especially items that we can produce locally, raw materials that we can source locally. Government can discourage the importation of such item by increasing the tariff. When we say tariff is a tax paid on imported goods into the country. So if government increase tariff on such commodities, then the price of such commodities will go up, which will discourage people from buying such commodities. Number 7, taxation policy can be used to stimulate recovery from a trade depression or to recommend a deflationary trend. So, if a country is experiencing depression or recession or deflationary trend, then taxation can be used. A good example is what is happening now in the world, where we have the problem of COVID-19, and various countries of the world have locked down their economy, and it is believed in Nigeria that the economy of Nigeria is going into recession. So, what is recession? Recession means a drop in the GDP of a country, in the gross domestic product of a country, which happens when the GDP drops for a period of 6 months, meaning 2 quarters. So, if the GDP of a country drops for 6 months straight away, so it shows that that country is in recession. So, what can government do to bring out the country from recession? Number 1, taxation is a good policy government can use. By using taxation, government will make more money available to the private individuals by reducing the tax they pay in order to stimulate the economy. So, if government reduce the tax the individual pays, then what will happen is this: the ability to demand goods will increase. Now, if their ability to demand for goods increases, it affects the producer of such items, because the producer of such items will be able to produce more commodities to meet up with the demand. And in doing that, he has to buy more raw materials, employ more labor factors, and all other factors of production to meet up with the demand. And this will stimulate the economy and return the economy back to the path of growth. 8, to stimulate further investment and economic growth. So, sometimes government can use tax to stimulate investment by encouraging investors to come into Nigeria and telling them that when you come into Nigeria in this sector or in that sector, then we are going to give you a tax holiday or a tax rebate. A tax holiday for 10 years, meaning for the next 10 years in Nigeria, you will not pay tax. And then this sometimes can encourage the industries to come into a country and invest. The last one there, to discourage dumping in international trade. Yes, when we say dumping, is a situation where a foreign country comes to another country and sell their goods lower than the neighboring country's cost of production. Meaning, for example, if US is coming to Nigeria to sell a product, let me give an example, a car, and both US and Nigeria are producing this car, and the cost of producing this car in Nigeria is 2 million. Now, US is coming to Nigeria to sell the same car at 1.5 million. You can see that it is the price of that car is very low compared to the cost of producing that car in Nigeria. We call that dumping. Now, that will affect the industry producing that car in Nigeria, because people will not buy that car they made in Nigeria car again. They will go for made in US. Why? Because number 1, US is a developed nation. Number 2, the price of such commodity is low, and based on the law of demand, that the lower the price, the higher the quantity demanded. So now what government will do is to use tax or tariff in case of international trade to discourage it by saying, if you are importing into our country goods made in our country, so tax or so tariff will be collected from you. So if government impose high tax on competitive goods that are made in your country and they are still imported into your country, if government impose high tax on such goods, then this will discourage dumping. So that will quickly take us to the principle of taxation. That will take us to the principles of taxation. Tax system must have the following features. Number one, general acceptability. General acceptability. That's number one feature of a good tax system. A tax payment should be acceptable. A tax payment should be acceptable to all eligible persons. They must pay tax willingly without complaint. They must see it as a levy that must be paid without question. So the structure of the tax, the payment of the tax must be accepted by people, because if people kick against it, then it's very difficult for the government to raise money. So a good tax system must be acceptable by all, just like the characteristics of money. Now, whatever is used as money must be generally acceptable. So also, whatever will be used as a system that will be used as tax must be generally acceptable. 2, certainty. Every taxpayer must be certain about what is meant to pay as tax and how much he must pay. So you must be certain. Oh, if I'm collecting social amount, how much is my tax? You should know as an individual how much you are paying. So you must be certain of it. 3, conveniency. Now, paying the tax must be easy, very easy. A tax system must be convenient for the taxpayer. A tax should be reduced at a convenient time and place. The most convenient time is usually at the end of the month, and the most convenient place is at the state of residence of the taxpayer. So you can't tell me that I'm working in Lagos now and I should go and pay my tax in Abuja. That is not convenient. You can't tell me that at the beginning of every month I should pay my tax. That might not be convenient for me. That's why a good tax system is structured in a way that you have to pay the tax in your state. They even have a platform now where you can transfer your tax through your phone to the bank account of the Federal Inland Revenue Service. So it has been very, very easy. They are really structuring that in Nigeria. So a good tax system must be convenient for the taxpayer. 4, economy. The revenue collected from tax must be of levying tax. Of course, when you want to collect this tax, there are costs incurred in collecting tax. So the revenue you are generating from the tax collection must be more than the cost you are incurring to collect the tax. Because if it is the other way around, then you are losing. Imagine it costs you 10 million to collect tax in Lagos, and at the end of the month you collected a tax revenue worth of 5 million. That's a loss. So the modality of collecting the tax from the people should be so easy and cost efficient in a way that the revenue will be greater than the cost of collection. Then you can make profit. 5, equity or ability to pay. A tax must be levied on each individual or company according to their ability to pay. Ability to pay is usually determined by the level of income of an individual or the level of profit of a firm. Hence, a person with higher income should pay more tax than a person with lower income. I think that is self-explanatory enough. So, meaning if you are collecting more money, you should pay more tax. Meaning the rich should pay more and the poor should pay less. Simplicity. Number 6, tax administration should be simple to understand by the taxpayer and the tax authority. So it should be simple to collect, it should be simple to pay, it should be simple to calculate. Flexibility. A good tax system must allow for adjustment or changes easily when necessary, of course. So when there's recession, when there's inflation, when the economy is not booming, when there's lockdown like this and coronavirus is affecting the businesses of people, then the tax system should be structured in a way that it will show what the economy is passing through. It should not be rigid. It should be flexible. So I want you guys to try this assignment. The difference between tax evasion and tax avoidance. So it's an assignment for you, and I want you to submit this in our next class. So quickly, we have types of tax. I gave this to you as an assignment in the last class. So types of tax. We have two types of tax. We have the direct tax and the indirect tax. So the direct tax is a type of tax that is imposed on the income of individuals and profit of firms. The burden of this tax cannot be easily shifted to another. Hence, it is borne by the taxpayer. Let me quickly explain. Now, this tax you are paying is direct. You are paying it directly. You are the one paying it as an individual. You can't transfer the burden of such tax to another person. For example, if you are a producer, you are the one paying it from your profits. If you are a worker, you are paying it from your salary. You can't transfer the burden, the tax, because tax is a burden. Imagine you are collecting 10,000 and someone asks you to pay 3,000 as tax. It's a burden. So you can't tell another person to pay that tax on your behalf. No. In some cases, it is deducted from your salary at the source. So even before your salary gets to you, it is deducted. So a direct tax system is a system imposed on the income of the individuals and the profit of the firm. This burden of this tax cannot be transferred to another person. Now, a good example of such tax is your personal income tax, your company income tax, and your capital gain tax. Of course, we have other types of such tax. So quickly, let's run through the types of direct tax. So we have number one, the personal income tax, which is a tax imposed on the salaries or income of individuals. It is based on the principle called pay as you earn. Pay as you earn. Now, it is applied to those who are working employees. It's applied to them, and it is progressive in nature. When we say progressive, meaning the more you earn, the more tax you pay. So if someone is earning 10,000 naira and another person is earning 100,000 naira, you don't expect them to pay the same tax. So the person earning 100,000 naira will pay more tax than the person earning 10,000 naira. So that is your personal income tax. Then the company income tax. This is the type of tax that is imposed on the company's profits. So we have a lot of companies in Nigeria, in Lagos. Now, at the end of their financial year, they declare profit. So if you check the newspaper, you see they will say they declare profit before tax, and then they will declare profit after tax. So the profit after tax is always lower compared to the profit before tax. So they pay tax, name it, Shell, Chevron, MTN, Coke, and every company in Nigeria must pay tax. Number three, capital gain tax. Now, this is a tax that government collect on assets sold. So if you are selling your car, you are selling your house, government collect tax on the profit made on that. So whatever you are selling, any capital goods that you are selling, I repeat again, any capital goods that you are selling, remember that appreciate in price, in value. A good example is house and land. So you might buy a plot of land, 200,000 naira, and in the next 10 years, you might sell it for 2 million naira. So it has appreciated. Now, that difference between the cost and the selling point now, the selling price, government will collect tax on that. Then we have capital transfer tax. Capital transfer tax. This is a tax imposed on wealth transferred from a living or dead owner to another person. So, meaning if your dad transferred the ownership of his property to you based on his will, so you must pay tax as a new owner of such property. It is obtainable in developed nations of the world. So, transferring of ownership of an item, example car, properties, from one person to another, involve that person must pay tax. We have the poll tax. This is a flat rate tax imposed on low income earners because their income is low. So some countries like India go for poll tax, where all those individuals pay a flat rate of 500 naira, or a flat rate depending on the amount the government want to impose on them. So it is regressive in nature, meaning because each payer pay the same amount irrespective of the high income, because they are categorized as low income. So irrespective of their income, they pay the same. So you cannot see that in their case, if someone is earning 10,000 and that person is earning 50,000 and government asks them to pay 500 as tax, so it is regressive because the poor person now is paying more, meaning the person collecting 10,000 is paying more tax, and the person collecting 50,000 is paying less tax. Why? Because they are just paying 500. So it is regressive in nature. Expenditure tax. This is a tax levied on the part of a person's income, which is actually spent. So if an individual is spending money, so on those money you are spending, government is collecting tax. We have the property tax. These are tax levied on capital assets. So indirect tax. Let me stop here for now and then go through this. Now in my next class, I'll not explain indirect tax.